Welcome to the Restaurant Boiler Room, Season 4, Episode 8. I'm your host, Rick Ormsby, Managing Director at Unbridled Capital. Today in the Boiler Room, I'll be replaying a recent webinar on Q3 2022 franchise real estate with guests Josh Lewis of National Retail Properties and Chelsea Mandel of Ascension. We will talk real estate deal flow, cap rates, due diligence, change in market conditions, risk factors, rent coverages, brands, geographies, and many other nuances that affect real estate valuations, acquisitions, and divestitures, particularly in these changing operating environments for underlying franchise businesses. The Restaurant Boiler Room is a one-stop shop for multi-million-dollar merger and acquisition activity and financial complexities affecting the franchise restaurant industry. We talk money, deals, valuations, and risk, delivered to the front door of franchisees, private equity firms, family offices, large investors, and franchisors on a monthly basis. Feel free to find our content at Unbridled Capital's website at www.unbridledcapital.com. Now, let's enter the boiler room.
Well, I'll just start rambling a little bit, and then we'll get going. I thank you for joining our webinar, and for those of you who will listen to this on podcast, probably I guess in maybe 21 or 28 days at the Restaurant Boiler Room. When you hear my voice, I just want to say thank you for listening. Podcast is really going really well. We're excited about it. We do that every month. Let's see, a little bit of ground rules here. We'll go for 1 hour. And then when we go for 1 hour, you guys can answer and gals can answer a question, ask a question if you like. There should be a chat feature at the bottom. And if you want to ask any kind of question during the presentation, please do. And we'll, let's the three of us kind of eyeball the questions as they come in. And we can just kind of answer questions as they come in. Keep in mind, we will have a replay available on our website at unbridledcapital.com. And then we will email you a copy of the replay if you signed up as well. So look for that in the next 72 hours. Other than that, I think I would like to say a couple of things like I usually say. State of the business for Unbridled. Yeah, just think for the franchise M&A activity this year, we've seen a little bit of a pullback. It's been quite a bit slower for us than it was last year. A lot of that was expected. And if you've listened to me a lot, you've heard this before, but 2021 was super pumped and supercharged with M&A. There are a lot of reasons. We had COVID sales, we had record profits, we had low interest rates, we had a lot of buyers coming back to the marketplace. And clearly as well, we had kind of the threat of increased taxes that were driving a lot of decisions on the sellers' ends to try to beat what they thought would be capital gains tax increases that didn't happen ultimately. So that's what happened in 2021. We knew it would be down a little bit in 2022, like we'd have a sophomore slump. But when, with the inflation, the high gas prices and the rising interest rates kind of combined and kind of sagging consumer demand, it kind of combined together to slow things down a little bit more than I expected. And so we continue to be a little bit off in terms of volume and activity. We're hoping that'll happen. They'll pick up later this summer and into the fall. But clearly we have a situation where, a lot of operators' businesses are worth a little bit less than they were last year because EBITDA is down. As a measure of EBITDA and a multiple of EBITDA, the business just isn't worth as much. So we're going through that adjustment a little bit, but I expect like everything else, it'll pick up in probably 6 months, maybe a little bit less, but we'll just keep an eye on it. And you'll always hear my perspective on here. So here we go. Let's get started with 2 minutes in. And I wanted to just thank both Josh and Chelsea for being here. I'm excited for today's webinar. And when you hear at the podcast, these are two really cool experts that know the single tenant market on sale leaseback, plenty of experience in franchise and restaurants particularly. And they also know the 1031 market, the sale leaseback market really well. And both have different areas of expertise. Both are excellent at what they do. And I just would start off and let's start with Chelsea and then go to Josh. You guys introduce yourselves. Thank you for joining.
Thanks, Rick. No, glad to be here. Yeah, so I'm Chelsea Mandel, co-founder, managing director at Ascension. So we focus on corporate real estate and sale leasebacks, typically working on behalf of private equity firms and other middle market and lower middle market companies. Do a lot in the restaurant space, a lot of the franchise space, QSR, also active in just kind of broader single tenant real estate like industrial, medical, healthcare, et cetera. And so my background, I started on the principal side, went to the advisory side, have since launched Ascension earlier this year. And specialize in sale leasebacks. Glad to be here.
Thanks, Chelsea. Rick, thanks for having me. I'm an SVP of acquisitions at National Retail Properties. We're a public REIT that invests exclusively in single tenant retail, including restaurants. We own about 3,300 properties in 48 states, including over 1,000 restaurant properties, about a $12 billion enterprise value, $8.5 billion market cap, principally doing sale leaseback transactions, also do some reverse build to suits, and quite active, have been doing franchise restaurant stuff for a long time. I've been here 14 years. Prior to NNN, I was in investment banking, real estate capital markets, and did sale leaseback advisory work. So I've sort of switched sides of the table in the opposite manner as Chelsea. So.
You said you're an SVP, and like for me, I'm like SVP. That sounds like Scott Van Pelt on ESPN, and you kind of look like him a little bit. I do too. You got no hair, man.
You and I are both follically challenged like he is. So.
Well, very cool. Thanks so much for the introductions, guys. So first question to both of you is macroeconomic picture. So I got a first question here is, how's the real estate market for buyers and sellers changed so far this year? I gave you my perspective on businesses. You're the experts on real estate. What do you think? We want to go in the same order. Chelsea, you want to go first and Josh second? We'll just tackle it. Yeah.
I mean, obviously a lot going on in the market. Interest rates are up 100 plus basis points since earlier this year. We have inflation at 9%. There's a lot of things kind of just macroeconomically that we're kind of all dealing with. But I think in terms of, deal volume and, pricing, I would say interest rates have certainly moved, but cap rates thankfully haven't moved as aggressively. What we're seeing is, I would say about 50 to, 80 basis points of kind of cap rate spreads. And so what you are seeing is a lot of volatility, right? So, CMBS market, CLO market, you are kind of seeing groups that are relying on asset level financing, maybe having a little bit of a harder time, getting their deals done accretively. So I would say from our perspective, on the seller advisory side, we are kind of seeing a widening gap between those cash buyers, groups like Josh and his firm, and, groups that are private equity funds or relying on asset level financing. It also takes us into the 1031 market pretty frequently. A lot of these buyers are cash. They are a bit more insulated from kind of the, challenges in the financing markets. But I think generally, from a demand perspective for the product that we offer on the sale leaseback side, the demand is still there, especially with the volatility. Buyers are kind of flight to quality assets and sale leasebacks with long-term leases and good credits, good operators, good brands. Those are still the deals that people are wanting to do. So from a volume perspective, we're still running competitive processes. And, I think activity has still been actually very strong.
Maybe stronger than what we're seeing on the operating company side in the M&A world. Interesting. What do you say, Josh? What do you think?
I mean, you guys covered sort of the macroeconomic backdrop. GDP's negative 2 quarters, inflation, 40-year high. The 10 years moved north of 100 basis points since year one. LIBOR and the 2-year Treasury have moved even more than that. High yield spreads have moved even wider than that. So sale leaseback, looks pretty attractive on a relative basis, and particularly in a lot of the transactions we're involved in, which would be, say, an M&A related sale leaseback. The sale leaseback, a marginal move in cap rates, 25, 50 basis points is pretty de minimis, relative to how the cost of other capital has moved. And frankly, it's not only a movement in underlying rates and spreads, but there's also just, less liquidity in other capital markets. It's hard to do a high yield deal. It's hard to do a high grade deal. Fortunately, as Chelsea said, NNN's an unsecured borrower. We don't use any asset level financing. We've got a big balance sheet and very long dated capital. And so that's been very advantageous versus, those folks that are relying on debt financing. So
you guys got a war chest of money. Let me see if I can unpack this. You got a war chest of money. You don't borrow money to buy real estate. You're a little less sensitive to changes in interest rates relative to other people who do borrow 80% of the money to buy the real estate. But either way, the interesting point of the comment also is, and comment on both these things, that what I just said, and also the second piece of it is you're seeing that, and I agree with you, that there's been less negative movement in both cap rates and interest in acquiring, on the real estate side than there has been from an M&A standpoint than on the corporate side, on the business side. where restaurant lenders have tightened a little faster and a little more.
Yeah, and just to be clear, I mean, we do use debt capital, but it's all on a senior unsecured basis. It's a corporate basis. It's, roughly kind of 40% leverage in our capital structure, and our cost of capital has moved higher. Fortunately, we were sort of well positioned for that, and we're not reliant on, say, the CMBS market or doing mortgage financing to fund an asset or a portfolio of assets. So equity prices have dropped pretty much across the board. Debt costs have gone up. So cost of capital has moved higher, but on a relative basis, it hasn't had that meaningful an impact on cap rates. I think cap rates will likely continue to move a little wider as the Fed continues to tighten. But again, a 25 or 50 basis point move in cap rates really isn't all that meaningful from a multiple perspective. And we'll talk a little bit more about that later. But, that effective move just isn't all that meaningful relative to other types of cap.
Our real estate transactions, they could be, thankfully as quick as like 30 days, but it could also be 120 days. And so I think cap rates are a bit of a lagging indicator versus like the debt market, which prices, spot, they could retrade your terms today. So I think there is that timing component that also is taken into play here.
Yeah.
And I would say that, because of that, there is a lag. And so we have seen some deals. Fortunately, we haven't been sort of in this camp, but I mean, deals have gotten retraded. We've seen deals that have fallen apart as a result of sort of move in the capital markets. So there is the longer nature of these types of transactions does make it harder to sort of value deals or price deals initially, because we're all looking at the yield curve and listening to the Fed talk about, rate movements and sort of wondering when and if that's going to happen and how that's going to happen. And a month ago, the 10-year was at 3.5%. We're down to 280. So we've got an inverted curve. So it's sort of strange times, but I think we're doing our best to navigate it. And I think, the sale and leaseback market is very open. There are some players that are sitting on the sidelines because they are more debt reliant, more asset level financing reliant.
Well, it's an interesting comment about the retrade portion, because, when you're selling businesses, there's all kinds of things that can happen that can cause or force a retrade or a discussion about a retrade. Some of it is that you go through and you find, the EBITDA drops a ton during due diligence when you're selling a company, or maybe you come in and there's all kinds of deferred CapEx in the stores, or there's a number of reasons, but typically you don't hear about real estate getting retraded much, and so to hear that comment, at least on the deals that we've done, we haven't seen a whole lot of that historically, but we're doing one deal right now that has that element in it too. So I think that's something that we should, as people listening and being concerned about real estate, we should know that that's maybe a little bit more on the table going forward because of the interest rate environment that we're in. Let's talk a little bit. Let me change and to ask this question: how is deal flow right now in single unit sale leaseback market and in portfolio deals in restaurants? To the extent you have a comment on that, does it mimic my earlier comment? Things are a little slower than they have been. What do you think?
Yeah, I could work in. I think they're a little bit slower than, things have been. Obviously, Q4 was like, everybody's favorite quarter. Things were just booming. But I think, kind of generally, just given all the different macro factors this year, year to date, it has been a bit slower. But I think from our standpoint, what we're doing is we're seeing a lot of valuations. We're seeing a lot of proposals. On the deal side, I think a lot of the deals that we're seeing are like the M&A deals where we're bringing in, a group like Josh's or, another buyer to execute a simultaneous sale leaseback. Typically, it's private equity firm. They've been consolidating up these family-owned operators. The sale leaseback's a big component of their entire cap stack. And so we're structuring that simultaneous deal. And so we're relying on the institutions to kind of come in, with our clients, taking down OpCo while they buy the real estate. And then a lot of what we're seeing is, they're going out and they're flipping these deals into the 1031 market. And good for them. They're making a nice spread on it, but it is a different deal, coming into that kind of simultaneous transaction, replacing a big piece of the sponsor's equity check. It is kind of a higher risk deal. I would say that's a lot of what we're working on. We're seeing a lot of proposals, for Pizza Huts and Sonics, Zaxby's, we just did a number of Taco Bell. So we're seeing good activity. I think on the single unit side, it's typically kind of after that initial, institutional portfolio deal that we're then flipping those out into the 1031 market.
Yeah, good. What about you, Josh?
Yeah, I would say, Rick, it has been a little bit slower on the larger kind of M&A, QSR, or even casual dining kind of restaurant deals where, as Chelsea said, there's either a strategic or perhaps a sponsor that's coming in and wanting to use sale leaseback capital to fund an acquisition. We are seeing it perhaps more in some other asset classes outside of restaurants. We're working on something with Chelsea right now in that regard. But as far as kind of big restaurant portfolios, not seeing as many deals. And I think that's to your point earlier that a lot of deals kind of got pulled forward. You're also dealing with a year ago, you were working off of great TTM set of numbers, and today your TTM set of numbers are, maybe showing some positive comps on the top line, but you're seeing margin contraction. And so, there's a bit of a disconnect between what sellers' expectations are and what buyers' expectations are. And I think that kind of leads into where we're very focused, and that, kind of gets into the underwriting of the unit level cash flows, among other things. So deal flow on restaurant stuff is a bit slower. We are looking at one very large transaction right now in the restaurant space, and I think that deal has some elements of that uncertainty around cash flows associated with it, which is complicating matters.
Yeah. And it's interesting. I want to talk, let's make sure we don't forget this, because I want to later talk a little bit about rent coverage ratios and how you guys think about rent coverage ratios, which is a key metric at which buyers look to stay above 2.0 when they do that. Matter of fact, let's just tackle it now. So, typically good old redneck here says, oh boy, like me, says, oh boy, I got a store doing $1 million in sales and I'm going to slap an 8% rent on her. And then I'm going to give her a 5.5 cap rate. And then off we go into the sunset. And that's whatever the number is, it's probably $1.4 million. Give me $1.4 million less transaction costs. And then I'm going to take an $80,000 lease on 20 years with 10% increases every 5 years. And that's how we do it. And everyone's going to take that 8% rent just because that's what everyone does, and the end. But clearly you guys are interested not only in cap rates, but rent coverage ratios. And rent coverage ratios are dependent upon your view of EBITDA. And so inherent in my question is, what do you think? I mean, how do you look at EBITDA? How do you think about rent coverage ratios? And how do you go about buying real estate? I mean, how do you think about pricing it and buying it?
Yeah, I could start, and then Josh, if you want to weigh in. I mean, I think that the metrics that you mentioned is typically what we're looking for when we're sizing up our proposals. 8% rent to sales, 2 times coverage at the unit level. Making sure the cap rate's taking into account the brand, the sponsor, the operator. All of that. But I think what we're seeing now is that EBITDA, that numerator in your EBITDA to rent isn't as straightforward as it used to be. Like Josh said, you're not looking at a clean TTM and saying, okay, great, that's the number. You're looking at the COVID bump, you're trying to make your adjustments, the buyers, and Josh could definitely speak to this, they're asking for more detail, they want more financials, they really want to, make sure that they're understanding that EBITDA and that they're giving credit to all the different factors in the macro environment that have either led to outsized numbers or, below average numbers. And I think that adjustment, true adjusted EBITDA is really being looked at a lot more carefully. But Josh, would love to hear from your perspective to make sure that our valuations are going to be, acceptable by buyers.
Look at him over there. He's like got a little frown on his face. He's got the like Ebenezer Scrooge look about EBITDA. Like, go ahead, Josh.
Look, all of our deals are sort of a 4-legged stool, and they always have been. It's real estate, it's unit level economics, it's credit, it's sort of the more art than science piece, which is, brand and management team and competitive dynamics and all that. And so we think about all of those things. So it isn't just a rent to sales or coverage sort of equation that is how you determine rent or how you determine cap rate. It's all of those things. And it's not a perfect box that, it's not all science. But there has been more art to the sort of unit level economic underwriting. And that's, we're going back to, if the store's been around for a while, we're going back to maybe 18 or 19 and seeing how that store was performing pre-COVID. And maybe we're taking kind of a 19 to 21 3-year average. And then we're looking at sort of the latest set of TTM numbers. And folks that think that they can kind of look, I think some of the buyers that Chelsea might go to in the 1031 market may not be as sophisticated as that. And maybe, okay, they take an 8% rent off of a TTM March set of numbers and they live with that. I'm going to say, well, let me look at the June numbers, because all the sort of labor and COGS stuff, you may not be fully capturing that in a TTM March 31 set of data. So we want to make, and Chelsea mentioned that, some buyers such as ourselves are buying portfolios and then flipping the assets. We aren't generally in that category. We are long-term buy and hold investors. I want to collect rent for 15 or 20 years. And so I need to make sure that whatever rent I put in place is sustainable, that I'm going to collect that annuity stream of cash flows. And so I need to make sure that that rent is going to be covered in a downside scenario. And if my tenant should fail, I also need to make sure that that rent is, from a real estate fundamental standpoint, something that's replaceable or close to replaceable. So, you kind of gather all this data and utilize your expertise and try and evaluate sort of what is the appropriate set of numbers. The other piece of this is that some buyers are wanting, to put more rent on the asset. Some buyers sort of think like I do, and they say, look, I want to make sure that, maybe we're a family office buyer and we're in the business of owning QSR because it's a great cash flowing business. It survived for eternity. It made it through COVID so well. And so we want to make sure that that continues. And so, they may not want to push rents to the nth degree. And so it's all sort of it's fuzzy, but you kind of work to a number and say, look, these are acceptable level of rents. And then you put a cap rate on it.
I think it's really good. Josh, thank you for that. I didn't mean to cut you off, but I'd make a couple quick comments to that. Number one, I think hopefully for those of you who are listening and watching, I think you hopefully heard that there's a little bit more scrutiny on the business operations now than what there has been historically. Okay. So that's just the state of the world that we're now living in. And that's, you can expect that your buyer of your real estate, whether it's through an advisor like Chelsea or a direct buyer like Josh, they're probably going to look at it a little bit more like a buyer of the business. Maybe, they're going to want to know the EBITDA, and they're going to want to know how the business fundamentals have changed to protect their real estate investment decisions. So that's number one. And then number two, I guess I'll just punt on it. We'll keep going, or we'll be fast. 122. Okay, so here we go. Let's go to the next question then, instead of me ramble. Number 5 on the list. Well, number 4 was why would an operator do a sale leaseback? It's kind of go ahead. Give your 2 cents. Why would I want to do a sale leaseback?
Yeah, I can start. I think it comes down to just operators and, private equity firms, whoever, they have a higher and better use of capital than owning buildings, so it's whether you're paying down debt or using the proceeds to finance growth, buying new locations, opening up new stores, or buying new equipment. It's just not a good use of their capital to be tied up in these non-earning assets for the company. If you're in the business of operating restaurants, you want to operate restaurants and not be in the business of, being a Josh, being a landlord.
Couldn't agree more with what Chelsea said. And I think, then it's the math piece of this. And that's the fact that a 6 cap is a 16 plus times multiple on cash flow. And your business probably isn't worth that kind of multiple unless you're somebody very special. So
I'm special. I'm very special.
Look, there are some businesses out there that are trading at multiples higher than that, but I like to think of rent as basically foregone EBITDA. And if you can get a materially higher multiple on that rent, on that EBITDA, then you should try and do that. And oftentimes there's a pretty big gap between, where you're selling a business at 5, 6, 7, 8 times, maybe it's 10 times in a Taco Bell, and 15, 16, 17 times multiple that you're effectively getting through the cap rate. And again, as I said before, even if cap rates have moved 50 basis points, you're probably only looking at a turn or so of lower multiple. So,
Right.
16 and a half becomes a 15 and a half. It's still a big number.
It's just financial arbitrage. Either you have a use of proceeds or you're just, financial engineer.
Yeah, the changes in the valuation of someone's total company are relatively low with a slight shift in cap rate versus a big shift in the change of debt financing on the. I'd say that opposite. You actually see a really big change in the valuation of a company based on the change in cap rate. Well, let me ask you guys this. Like, let's tackle this idea of 8% rents. I get this asked a lot, not so much in the Yum system, KFC, Taco Bell, and Pizza Hut, because corporate, the franchisor will kind of come in and kind of say, we're kind of capping rents at 8% of sales fixed at closing on trailing 12-month financials. But in other brands where there's not maybe as much of a policy, I feel the question a lot, like, why can't I put my rent at 9% of sales, or why can't I put my rent at 10% of sales? And of course, my answer is that once you do that, and you do a lease adjusted leverage calculation, you almost have, because it's so heavily factor that calculation into how high the rents are, you really aren't left with any business value, and no one will lend money against you. But most of the franchisors are also doing those same calculations and not wanting the lease adjusted leverage to be over like 5 or 5.25 or 5.5, depending on the brand. But what say you to someone who gets through to you and says, I want 10% of sales rent on my piece of property, in restaurant property, let's say. Yeah,
it's hard. We've had operators, a lot of the time it could be the private equity owners who just want to juice proceeds, and we get it, especially it's simultaneous with the deal, right? It's directly replacing equity. But I think at the end of the day, there's the operational concern for, is this sustainable for the operator? Do you want to be in business for the landlord, or, do you want to actually have a healthy company that generates positive cash flow? But it's also, from the investor's perspective, and from having been on the investment side, like, that rent's not going to be reproducible. So it just makes the whole real estate fundamental equation much more challenging, because maybe this operator could afford it, but then you're thinking about your exit, potential dark value. You're in the real estate for a basis that makes no sense. You can't replace the rent because this is an acre site, and that rent number makes no sense in the context of what you could actually release it for if this operator were to go away. So I think there's a lot of different considerations, both from the financial, health of the company and being able to, pay this rent for what could be 20 years. I mean, these are long-term, obligations that you have to live with, but also from the investor's perspective of, do the real estate fundamentals check out from the basis standpoint? And is this rent going to be, replaceable?
What you said about being about working for the landlord, I mean, I think that's a really, I always tell people that my heart is always in I come from the standpoint of the mid-size operator. That's kind of where I cut my teeth, right? Like the 30-unit Taco Bell operator or whatever. I mean, I have watched in my 20 years of doing this, operators who have done, Chelsea, what you've said, which they've either inherited leases or they've done sale leasebacks, either at too high of a number, or the business dropped in sales and the rent therefore was really high. And I've seen them do what you described, which is working for the landlord, operating this business with a noose around their neck and really working just for the landlord. And it's some of the most miserable stuff I've ever seen, like people who are under that, because you can't get out of it. It's almost like it's a self-fulfilling prophecy of spiraling. So I think it's a really, really common, thing to be thinking about. Josh, you got a comment on it too?
I think Chelsea nailed it. I mean, again, we're looking at it on a long-term basis. The rent's got to be sustainable. There's probably some rent bumps in the lease as well. So, that rent's going to be increasing over time. There's got to be a margin of safety. And again, to us, the coverage metric is probably more important than the actual rent to sales. But I've seen very few businesses that can truly support, something north of 8.5% rent to sales. I mean, you can have some very high margin businesses. There's some very high margin concepts, but generally speaking, we got to think about, what are those absolute level of rents? Are those replaceable? executive team always harps low rents, low price points. It's at the end of the day, that's how we best protect ourselves. And so I'd rather get a little lower yield at a lower rent to sales or higher coverage than higher yield, higher rent. That's not really kind of the trade-off I want to make.
I saw a question come in here, which won't surprise you guys. We decided to punt on it when we did the practice session. Are the risks real that the 1031 tax deferrals will be restricted in the Biden 2023 budget? And what's the cap rate impact of that? I suppose you guys are going to say, I don't know, but there has been banter that anything more than $500,000 of gain would have to be, is that what it is? It would have to be realized and taxed this year?
Yeah, I think $500,000 is protected, and that's everything else is just subject to, I guess, traditional gains. I don't know. I hate being wrong, so I'm not going to set myself up for a year from now to be wrong.
Yeah, nor am I. I mean, they just did this, small Build Back Better or whatever they're calling it. And I mean, the tax element of it changed overnight. So the idea that Chelsea and I would have a real clue as to what, the 1031 rules might look like at some point in the future, I mean, we don't know. There's
sell your real estate now if you're worried.
Yeah.
I mean, it's funny. There's it's crazy. I shake my head at the level of distrust with the government. I was just getting a driver's license today because we just got a new house, and they asked me if I wanted to be an organ donor. And the lady said, well, most people don't do it around here because they're afraid the government's going to knock on their window and come steal their organs from them. Like I'm like, really? Like, so geez, there's so there's a lot of fear that could go around. But if it is true that if someone owns $100 million of real estate and they've got a $50 million gain on it, and they have to realize $49,500,000 of that gain and pay taxes on it and can't defer it through a 1031. Now that I have no knowledge about whether this will happen or not, but if that were to ever become in play, I think everyone would be jumping from tall buildings in the real estate.
Yeah. I mean, there's a pretty big lobby around this. I mean, private equity got carried interest, pushed to the sidelines. So I think it's a pretty big issue. And, again, I don't want to make predictions either, but I'll leave it at that.
Take me to cap rates then. What's going to give me some? Another question was asking specifically in brands, okay? And it was that specifically, we won't mention the brands particularly, but the two brands that were mentioned were QSR brands that are typically two of the 3 or 4 best performing, most attractive brands. So take us through your all's thought on when you're selling real estate in let's call it a bucket A, bucket B, and bucket C. Okay. So bucket A is going to be the highest quality QSR assets, in great geographies. Bucket B is, a little bit less, but still pretty good. And then bucket C are smaller concepts. Take us through those buckets, how you think about cap rate pricing. And then after that, I'm going to ask how is that going to be changing in the next 3 to 6 and 9 months? But what do you think, Chelsea? What do you got?
Yeah, I mean, I think your best stuff, somewhere in the 4s, high 4s, then kind of just goes 5s to 6s. A lot of the portfolio deals are getting done, in the 6-ish range, when they're kind of the M&A deals. And, like I mentioned before, not really a Josh strategy, but if they are going to be flipped out after, or if we are just looking at them at one-offs, we're looking at something in the 5s. But, I think everybody thinks that cap rates are going up. We've already seen it. Like we said, I would say, if I had to put a number on it, they're probably up 50, 80, somewhere in that range, basis points. And I think they're going to continue going up. I mean, there's no reason to expect that cap rates are going to go lower with everything that we're seeing. And, if they went back to 2016, 2017 levels, I think there's probably another 100 basis points or so to go. But, I think, like Josh said, even if those movements come to fruition from a multiple arbitrage perspective, it still makes a ton of sense. You still have a ton of spread. You're still, even if you're at like a 7 cap, it's 14 times. You're really not selling your business for 14 times or greater than that. So I think maybe the spread shrinks, but when you look at alternative forms of financing and what that means for, if you're not going to do this and you're just going to finance your real estate, what does that mean for your interest rates on a mortgage? And I still think that the relative arbitrage still makes sense.
Yeah, I'm still doing a math equation here. So this is interesting though, but even if we think it's going to go up, the 80, as you say, 100 basis points from here, that would make, on a simple $1 million deal, if you were going to sell it at a 5.5 cap rate, right, you'd be getting 1.45 million. And if you're going to sell it at a 6.5 cap rate, you're going to get 1.23 million, right? So that's over 200,000, which is a 20% drop in valuation. So this is just to hear it, if you're listening on this call, man, or on the podcast, like what you just said is not immaterial. Prices are going to be getting worse for the value of your real estate because the interest rates are changing. And if the cap rates change by 100 basis points or 1%, and if we use the example of going from 5.5% cap rate to a 6.5% cap rate, you're talking a 20%, possibly 15 to 20% drop in your valuation. Now that's if you were paying all cash.
Well, but Rick, that also assumes that the cash flow of that asset hasn't moved, and I would suggest that the change in margins and they've directionally been EBITDA margins have been declining. That's probably a more meaningful driver of the difference in valuation. But yes, you're correct. In terms of sort of your question, I agree with Chelsea. Look, there's a whole category of QSR that we've never been able to touch. The McDonald's, the Chick-fil-A's, the Chipotle's, those have been really the bevy of the 1031 buyer. Those yields have never been in a place that have made sense for a institutional buyer. Just there's no spread. We are in the spread business, really. But, your garden variety and Taco Bell and Wendy's were mentioned in the question. Those deals that might have been kind of high fives on a portfolio basis, say end of last year, are probably in the low sixes is sort of a good number. Maybe it's 6.5 if it's a, slightly more marginal credit or weaker performing assets or
outsized rents that are too high.
Exactly. So there's so many variables that come into play, but again, I think directionally, and one other way to think about it is that, some of the stuff that was trading at the lowest cap rates, those have probably moved wider than kind of the middle market franchisee credit that Rick, you generally have been selling. Again, those deals are probably 25 to 50 basis points kind of move. We did a deal that you were involved in that closed, I think, December 30th of last year. That deal today is probably 25 basis points wider today.
Okay.
So,
yeah. I thought it was interesting too. Chelsea was the one bringing it up earlier about how, on another call, about how geography kind of makes a difference too. We've always known that, right? And to put, and you were saying, Chelsea, and maybe expound on this, that like California is an area that where when you're doing single unit, selling single properties, that's a really hot area. And then you pick no tax states like Texas, Florida, and Tennessee, right? Yeah. Tell us a little bit about how you think about geography when you're selling these assets.
Yeah, no, for sure. I think in terms of those markets, it's the 1031 driven kind of component there on pricing. So the tax-free states, California, it's really, I would say, heavy loaded 1031. But in terms of the geography, I think, it's a consideration right now, especially in like flight to quality, right? Like the real estate fundamentals, again, we come back to that, can you do something else with this property? Like people are going to pay more. They're going to focus more on these better located assets, Maine and Maine. You do have to think about your downside more than you would in kind of just a, not as volatile market. So I think that's coming into play, and then just like on the rent side, obviously, if you're in the middle of nowhere and it's a challenging credit and it's, not one of the top brands, you're paying more attention to your rent numbers, making sure that your coverages, your rent to sales, all these different kind of factors when you're underwriting, that these all check the box and make sense. I think you can be a bit less stringent on your underwriting criteria when you have the real estate fundamentals kind of backing you up. Your basis makes sense, land values, your real estate is stronger, you're at kind of the broad intersection, you have the traffic counts, it just kind of prevents you from having to be so strict on those, 4 prongs that Josh mentioned.
Yeah, it's good. It's great. Thanks for sharing that. What about, talk to us a little bit about the process and timeline of selling real estate? Like, give us a 101. So assume I don't know anything. Like, what happens? I got a piece of real estate out in the field with a KFC sitting on top of it. What happens?
Yeah, I mean, obviously, we always start with valuation, just like you do. I'm sure when you're pitching business, make sure we're on the same page. We're setting expectations. We come to you with a proposal. Here's where we can execute. We're typically giving a range. We're showing them our proposed lease terms. So if they say, hey, we want to pay 10% rent to sales, we're saying, no, here's our valuation. This is based on this set of lease terms. And this is what, we would recommend that buyers will get on board with. This is what we should go to market with. We'll present that, that range of valuation, those lease terms. Typically, if they're ready to make a decision quickly, it moves rather, fast, maybe a week. We're signed up, about a week and a half to get our packages ready. We get a data room going just like you, and we go out to our buyer network. And I would say typically within, 3 weeks, we have offers in, maybe another week or so to kind of refine LOIs, get our, best and final, get to a point where we're ready to execute an LOI. And then this is where, the market has moved a bit. I mean, I would say traditionally, it's like a week and a half to 2 weeks to get a PSA executed. Then you have your 30-day diligence and then, 15-day closing. And that was kind of the norm. Now I'll tell you, we just signed up a deal. It's a 25-day diligence, 5-day closing, and the diligence is starting upon an executed LOI. And, that's extremely fast, but we're doing this because we're trying to box in risk as much as possible and really, try and mitigate any potential retrades because we're just boxing in that time so that they have to move so quickly. Even if the markets move, they're hopefully not going to move that fast that we could kind of run the risk of a potential retrade. And so in order to accommodate that and, make that possible, we're kind of taking some steps, to make that timing work. So, we're having our sellers, our clients order third-party diligence, get their phase ones going, get the survey started, start opening title. And then we're, assigning those reports to the buyer so that they can just come right into third parties instead of waiting for that executed PSA. And a lot of buyers, I know Josh on one of our last deals, you guys are comfortable starting diligence with the executed LOI. We're getting an access agreement in place versus waiting for a PSA. And it's just helped us speed up, a lot of these processes, and we're keeping the deals on the market shorter so that, we're able to close quicker and make sure we're really mitigating that period of risk.
Let me jump in, and I want you to answer too, Josh. Chelsea, that was a great answer to that question. Yeah, I would say the same thing's happening in Unbridled's business too. I mean, probably half of the deals we're doing this year we're not taking to a broader market because we're worried about the amount of time that it's going to take, and we're really under pressure to get it done quickly with changing interest rates and changing borrowing, credentials from the buyers. So I kind of echo that. You kind of sound almost exactly like we do. Your timelines are a little bit unrealistic for selling a company because we got to deal with franchisors and we got to deal with all these things that take more time, But it's the same steps. Obviously, I would just say the same steps, but I didn't follow the numbers exactly, but probably double everything she says, and that's kind of what we go through. But noted that we want speed because we have a lot of. You said boxing in risk. We want to box in risk in a time where we have a lot of uncertainty.
If it were up to the buyers, most of them probably wouldn't retrade, but they're getting retraded by their lenders. And so it's really just for groups that are financing, especially, this is a bigger consideration, but it's not always in their control. There's always, vendors and other people that are just kind of slow in these processes. So we're just trying to do everything we can to speed it up.
What do you say, Josh?
Chelsea kind of walked through her timeline. I mean, ours is a little different depending on kind of how the deal is being sourced. I mean, sometimes we're seeing deals from Chelsea and her peer brokers. Sometimes it's a, relationship tenant. Sometimes it's somebody that calls out of the blue and says, hey, I've got 10, this, that, or the others. Can you take a look? What can you do? I mean, ultimately, it starts with gathering data, addresses, store level P&Ls, some kind of at least high level corporate financials, pretty quickly based on technology and our having done this a million times, we can kind of chapter and verse say, here's what can be done in terms of, here's acceptable level rents, here's cap rate, here's what the lease term is going to look like, here's what the basic terms of the triple net lease are going to look like. And we could have an LOI to somebody on a deal in a couple days. I mean, it's obviously easier if you've got more data, but oftentimes, we can turn around our thoughts on a particular opportunity very quickly. That LOI may get negotiated. Once it's signed, you go to negotiating a contract and a lease. If it's in the context of an M&A deal, you kind of have to marry that to the underlying PSA or LOI on the M&A deal. Chelsea talked about third-party reports. I mean, we need title, survey, environmental, zoning reports. We don't do appraisals, and we don't have a lender looking over our shoulders, which helps us from a certainty of execution standpoint. But, the third-party reports tend to be a gating item. It's taken longer. It's taken longer since pre-COVID. Even to pull title depends on the jurisdiction. Environmental services providers have tried to skinny down their liability. There's all kinds of issues that you encounter, but ultimately you get through the third-party reports, you get through the negotiation of the contract and lease, and, address any kind of titles, survey type of issues, environmental stuff, and then you close. I mean, we can start a deal and kind of be done in realistically 45 to 60 days. Have we moved faster than that? If, the stars are aligned, sure. We're working on a deal today where the third parties were ordered and, you close in 30 days. It also depends on if it's a repeat deal. We tend to do a lot of repeat transactions with folks. And so you don't spend a lot of time renegotiating the lease or the contract. And so that's kind of how it works. As Chelsea said, some buyers have lenders that they've got to work with. That adds a layer of uncertainty to things, particularly in this kind of world that we're this macroeconomic environment, capital markets environment, et cetera. So
one of the things I just would, again, highlight, these are good comments, getting in front, like whether you're selling someone's company or selling someone's real estate or both or whatever you're doing, getting in front of the key gating items early in the process is really a wise thing to do now. Sometimes if we're selling a large company for somebody and we know that there's going to be, quality of earnings that's going to be ordered by the, family office or private equity group. In the past, we haven't been so aggressive at trying to pull that forward and to do that quality of earnings before the business goes up for sale. Because that cost then has to be borne by the actual seller of the business. And it can be $50,000, $100,000. It's expensive on a larger transaction. But those are the types of things in our process that, like, sometimes if you delay it during due diligence, it can stretch the deal out a little bit more. So those are some of the things like ordering appraisals and things that you can get in front of.
Well, yeah. And as Chelsea said, like, we're seeing more and more deals, particularly when a seller knows that the real estate component of the transaction is likely to be large. It's a large piece of the capital stack. There's going to be a sale leaseback regardless of buyer. Now, not every buyer wants to monetize every asset. Like, there could be elements of the real estate that doesn't get financed, but if the seller is wise, they get those third parties ordered, ahead of time. It expedites the transaction, and it's all math. Some of those costs might be eaten by me ultimately if I end up, buying the assets, but it's an upfront cost that may be, worthwhile for a seller to expend upfront to add certainty to the transaction.
And also from an advisor standpoint, and Chelsea, you'd probably agree with this, if the seller agrees to spend the money, to make the deal go faster, you probably feel better that you've got a committed seller. We typically don't have that problem as much, but some people do, I know. So
we would appreciate that. Yeah. I mean, I think for us, it's typically our clients are bringing us in, like when they're bidding on a business or when they're, like looking at a deal with the banker, they are even spending money before they know that they're awarded the opportunity. And we're advising them saying, hey, look, you're going to need phase one surveys, title work, property condition reports. We are trying to actually encourage them to order as much as they can, even before they're awarded the business. Like, some of them are just running full speed at, trying to get it closed and, whatever kind of structured deal that is, but they're not actually like signing an APA and then getting their diligence process. They're kind of just, doing it all at the same time. So in those situations, we're telling them like what the sale leaseback buyer is going to need. Cause like Josh said, especially if the real estate is a larger component of the deal, like if there's environmental issues, we want to get in front of it. We don't want surprises when we have the sale leaseback buyer already in the mix and then, things could fall apart. We lose our leverage with the competitive process. We're now working with one buyer. We don't have our, 3 backup buyers. And so things can get challenging. So to the extent that we know of any issues or to the extent that we can just convince our clients to really get a jump start on those reports, we go that route.
Awesome. Let me say something here that I really think is a great question. I'm sorry to cut you off, Josh. I know you had something to say. There's a question that I think is a really good one here. It's how do you value the sub 2.0 rent coverage sites in a portfolio? And how do you value mini master leases and sub 1.0 sites and big franchisees? This is a very good question.
That's what I was pointing to. I saw Mike's question there.
Yeah, so, these are questions. I mean, I deal with this on every single deal, right?
Maybe I'll tackle that one first. Look, some tenant / sale leaseback users won't do master leases. Perhaps the franchisor doesn't allow it. Perhaps the lender to the tenant sale leaseback partner of ours won't go for it. Master leases tend to be kind of a credit enhancement tool, particularly in a scenario where you have some assets that aren't performing as well as others. I guess our thought around that is you got to be really cautious about wanting to monetize those assets that have weak coverage. Like, you shouldn't be entering into 15 or 20-year sale leasebacks on assets that aren't covering or are barely covering. And usually those are low volume stores. So low volume, lower margin. Those may not be assets that the operator / tenant is likely to operate for a long time. So there could be plenty of reasons why, a certain store, there was a road closure. There were some circumstances that are driving that coverage. But I would certainly say if it's a lower volume store, or it's always been a low margin store, or it's always been kind of one of those, questionable, is this a long-term, has the market moved kind of stores, those may not really, those perhaps shouldn't be in the sale leaseback to begin with. I think you can get away with some sub 2.0 coverage stuff in a master lease context, but if it's probably sub 1.5 times, 1.25 times, depending on the circumstances, there isn't a answer that like for every situation, but those are just assets that beg spending more time thinking about whether they should be part of the sale leaseback to begin with. And so that
political answer. Look at you giving the political answer, man.
Well, I mean, I
how
know,
much does it affect cap rates? How much? You got a bunch of them that drop the cap rate 50 basis points, or are you more likely to walk away from the deal if you see?
Well, I would say, look, yes, cap rates are a reflection of risk to some extent, but we never really solve risk with materially higher cap rates. All you're doing is potentially making the situation perhaps worse. Again, that's sort of the thoughtful process, whether you're, NNN as buyer or whether Chelsea is your advisor, is figuring out which assets to include and where to set the rents. It's only a sub 2.0 coverage because that's the rent that you put on it. So maybe it warrants lower rents. And so those are all things that we consider. It's very important. And, at the margins, that tends to be something we spend probably more time thinking about those kinds of things than the store that's, 4 times covered, certainly.
One of the things go ahead, Chelsea. Yeah.
And I was just going to say, I have kind of 2 points on that. I think for us, when we see that, it's, either what you said, the rents are just too high and there's something wrong, or it's an operational issue. Something happened at the site. Like you said, maybe it was a situational, factor. And so when we see those situations, we're trying to understand, are you leaving money on the table by, trying to size off of a rent that has been impacted for some reason? Maybe it's a new location or, and whatnot. And so we always run the analysis of maybe it makes more sense to just hold off on that site, exclude it from the deal, wait until it can support a market rent and therefore a market valuation based on, a regular kind of recurring or fixed, EBITDA at the site, whatever it is that's causing that issue. The flip side is we do a lot of deals, like not in the QSR space, but with, like a C-store operator in South Florida, really great real estate. Coverage is a lot of the time limited, operational, it's just a small business, or they're trying to juice proceeds. And so you're not at, 2 times coverage, you're something south of that, but it's kind of like a covered land play. The residual value is so strong that you almost don't care, right? If the coverage isn't there, the investor has value in the dirt. And so, you're not as worried. So I think those are the kind of situations that we see. But if it's just an operator wants to juice rents, I agree with Josh. I don't think there is a price. You can't solve that issue with just a higher cap rate, because a lot of the buyers will just say, no, we don't want that in the deal regardless.
Yeah, I mean, we did a deal with, I would call a questionable credit several years ago, and we were hopeful that the business could kind of get turned around. COVID sort of interfered, but the whole much of the thesis around the deal was it was very low rents and low price points. So to kind of Chelsea's point, we obviously wanted the business to perform. We wanted them to pay the tenant to pay us rent for a long period of time. But if the rents are set at a level that it's low enough, there's some layer of or level of confidence you can garner simply by it being very replaceable rents and or highly alternative. We can knock the building down and ground lease it to somebody. There can be sort of other angles, but no.
Well, let me say this from the M&A advisory standpoint. You talk about a master lease, which is basically you have an overall lease over all the stores, so that if any one store can't pay the total amount, right, then the other stores will kick in the extra rent to make the total. And Josh called that a credit enhancement. And you could see why the buyer of the real estate, if they had an overarching master lease over top of it, would either do one of two things: either make them more comfortable with the deal, presumably, or it would, maybe improve their price in terms of how much they're willing to pay you for the restaurants, right, or the businesses. From an M&A advisory standpoint, I would just caution the people listening that master leases are very difficult to sell. If someone is an operator who has a master lease on a lot of restaurants, and then he or she comes to us and says, we want to sell this business and it's got master leases on it, it probably drops the buyer pool, unfortunately. So those are just things that I would caution people to consider. And this is not a knock on either of you, but it is an advisor's comment to say that you need to talk with an advisor that sees both sides of the picture before chasing a slightly higher price on the real estate side at the benefit of a higher price, but hard or impossible to sell later when you want to leave.
I would also say, Rick, there are certain franchisors in QSR land that frankly won't allow for master leases anymore. They've been burned. Chelsea was going the direction of there's some benefits in a bankruptcy situation to the landlord, and the tenant would have to reject basically the one lease, a lot of assets. So that it's unlikely that the tenants to walk away. But from the franchisor's perspective, they may have to step into the shoes on, a large master lease involving a lot of properties to kind of preserve the, basically their royalties. So master leases can play a role in certain transactions. They are by no means kind of the norm.
Yeah. Great. Yeah. Well, you guys, we have like another list of 4 or 5 questions, but we got to have a hard stop here in a minute. So I want to thank you both for your time. I thought this was a really good discussion, a lot of depth around the real estate discussion. Thank you both. And for those of you who have watched today or listened on podcasts, you've got Josh Lewis and you've got Chelsea Mandel. They're both on LinkedIn, and you can find them on their company websites. Ascension for Chelsea, National Retail Properties for Josh. I'm sure they'd be happy to answer questions for you related to real estate. You can call me, or I could get you in touch with them too. Thank you all for your expertise, and thank you to everyone who's been a part of this webinar. I really appreciate it. And go get them. It's going to get better. Come on, we got
Thanks,
it.
Rick.
Thanks, Rick. Thanks, Chelsea. Enjoyed it.
Good to see you guys.
All right, take care. Thank you.
Ciao.
Thanks so much for entering the Boiler Room today. You can find our podcasts on iTunes, Google Play, Stitcher, TuneIn, and Spotify. If you like these podcasts, please listen, rate, and review. I also encourage you to visit our website at www.unbridledcapital.com for the best franchise M&A and financial resources in the industry. Our website includes webinars, podcasts, videos, white papers, and a list of our past M&A transactions. Please note that neither Rick Ormsby nor Unbridled Capital Advisors LLC give legal, financial, or tax advice. These podcasts represent opinions that have been prepared for informational purposes only. We expressly disclaim any and all liabilities that may be based on such information, errors therein, or omissions therefrom.